Welcome to TalkTickers. Today we're doing a deep dive into Scotiabank's latest earnings call.
That's right, Q2 fiscal 2025. We've sifted through the results, the commentary, the Q&A.
And our mission, as always, is to cut through the noise, pull out the key insights, and help you understand what really matters from their update.
Yeah, and this quarter, it definitely had some interesting points. You see the bank trying to manage this, pretty uncertain global economy.
Right.
While also pushing forward with their long-term plans. We want to get past just the headline numbers.
Exactly. Understand the story behind them, especially that credit picture. That seems crucial this time.
Definitely.
Okay, let's jump right in then. The results snapshot for Q2. They reported adjusted earnings of $2.1 billion.
Which works out to $1.52 per share on an adjusted diluted basis. But, despite some good underlying stuff, the reported ROE, return on equity, it slipped.
How much?
Down to 10.4%. That's 90 basis points lower than last year.
Okay, but revenue momentum looked pretty good?
It did, yeah. Revenue was up a solid 9% year over year. And NII, net interest income, that was even stronger, up 12% year over year.
And that implies margin expansion.
Exactly. The net interest margin, or NII, was up 14 basis points compared to last year, and actually up 8 basis points just from Q1. So that's helping drive the NII growth.
So top line and margins heading in the right direction. But the number that really seems to have hit that ROE was the credit provisions.
The PCLs, yeah. Provision for credit losses came in at $1.44 billion.
Which pushes the PCL ratio up to 75 basis points. That's a jump of 15 basis points just from Q1.
And here's the really critical part, the thing you need to focus on. Management was clear this increase was almost entirely driven by building provisions for performing loans that aren't actually bad yet.
Okay, so a big build for potential future problems. We definitely need to unpack that.
Absolutely. But just quickly on the operating side, pre-tax, pre-provision profit, so profit before those loan losses, that grew a healthy 10% year over year.
And they hit positive operating leverage again.
Yep. Year to date, it's 2%. That's their 5th quarter in a row, keeping expense growth below revenue growth. Shows discipline.
And capital. Balance sheet strength.
Very strong. The CET1 ratio, key capital measure, is sitting at 13.2%. That's up 30 basis points just from last quarter.
Okay, so let's sum up the headlines. Good revenue, good underlying profit growth, strong capital. But the story is dominated by that big build in credit provisions, specifically for performing loans, which hit the final profit number and ROE.
That's the picture. Which leads us straight into management's perspective. They were very upfront about the, significant global economic uncertainty out there.
So what's their focus?
On what they can control. Strengthening the balance sheet further, investing in the business wisely. They stressed keeping that positive operating leverage going and being ready to grab revenue opportunities when they see them.
And they mentioned a specific driver for caution.
They did. Tariffs. That evolving macroeconomic picture, particularly around potential trade impacts, is leading them to take a more conservative stance right now.
Makes sense. And that conservatism, you'd expect it to flow into their strategy and how they use their capital.
Directly. Which brings us to capital allocation. Big news here.
A dividend.
Dividends back to growth. They bumped it up 4 cents to $1.10 per share. That's a positive signal.
And the buyback.
Also significant. They announced a plan to buy back 20 million shares. They frame this as, real confidence in their capital generation ability and their overall balance sheet flexibility.
So they're comfortable with the capital level.
Yeah, they said they're fine with CET1 in the 12 to 13% range. That gives them room. And the buyback, it's a tool they can use, especially, they hinted, if the share price stays where they think is, undervalued.
Okay, strategy-wise, what's the top priority?
Client primacy, earning that main bank relationship, and growing core deposits. That's their North Star, as they put it.
Making progress there.
Seems so. The loan-to-deposit ratio improved again, now at 104%. That's like 10 quarters straight of improvement. Deposits are up year over year in most areas.
Is that just nervous customers holding cash?
Partly. Management acknowledged that, cautious clients. But it's also good for the bank's funding. They highlighted adding almost 400,000 new retail primary clients since the strategy started.
And converting existing ones?
Yep. Working on converting the near primary and also boosting retention. They made the point that primary clients are way more valuable, like 5 times the revenue.
So how are they driving that?
More engagement. Canadian retail advisors are making 20% more client calls, more financial plans being done, more specialist advisors.
And small business.
Strong acquisition there too. 17,000 new relationships in Q2 alone. They said that's a 5% net client acquisition rate year to date, which is well ahead of the market.
Okay, so client focus is key. What about efficiency? Operational excellence?
Still a major focus, delivering that positive operating leverage while still investing for the long haul. And they gave a cool example using AI.
Oh, yeah.
Over 70% of commercial client emails in Canada are now processed by AI to create structured case files, basically speeding things up, boosting productivity.
That's pretty specific. Shows they're embedding it.
Right. And despite the Q2 ROE dip from provisions, they reiterated their medium-term target. 14% plus ROE. They still believe they can get there.
All right, let's see how this played out in the different business lines. Global wealth management.
Standout quarter, earnings of $405 million, up a really strong 17% year over year.
Broad-based growth.
Seems like it. Across different parts of the wealth business, they're adding new things like private asset solutions, active ETFs. Canadian Wealth saw good growth in fee-based assets, plus higher trading on iTrade.
Any new initiatives?
Launched a signature banking offer for a wider group of high net worth clients, and referrals between wealth and the other banking divisions are really clicking. $6.7 billion year to date, up 6%.
Assets look good too?
Yeah, AUM up 9% to $380 billion, AUA up 6% to over $710 billion. International wealth was also up 7% earnings growth, mainly Mexico, though FX took a bit off.
Okay, what about global banking and markets, GBM?
Also a strong quarter. Earnings up 10% year over year to $413 million. Revenue jumped 18%.
Drove that.
Investment banking was key. Underwriting and advisory fees were up 26%. Really strong. Management did say broader capital markets activities slowed down a bit in April, with the tariff uncertainty.
But M&A held up.
More than held up. M&A related revenue was near record levels. Get this. M&A fees in the first half of this fiscal year have already beaten the entire total for fiscal 2024.
Wow. That's quite something given the backdrop.
It really is. Shows strength in that specific area. They're focusing on what they call balance sheet velocity, building out niche capabilities like mortgage capital markets, leverage finance, structured credit.
But overall loans were down in GBM.
They were down 16% year over year, but they said that's deliberate. Optimizing risk-weighted assets, RWA, not just chasing loan volume. And operating leverage in GBM was excellent, 6.2% year to date.
Okay, now for Canadian banking, the picture sounds a bit different here based on the overall PCL impact.
Yeah, the bottom line number reflects that. Earnings $613 million, down 31% year over year because of those performing PCLs hitting this segment hard. But pre-provision profit was only down 1%.
So the underlying business was okay.
Reasonably stable. Average loans up 4%. Mortgages, RESOL up 6%. Credit cards up 4%. Deposit growth was actually quite good, up 5%, outpacing loans driven by non-personal deposits.
But the margin came under pressure.
It did. Canadian banking NIM was down both quarter over quarter and year over year. Management blamed deposit margin compression from, rate cut impacts and expectations.
Non-interest income.
Expenses. Non-interest income up slightly, 1%. Expenses up 4% year over year on tech and people costs, but down 2% from Q1. So year-to-date operating leverage here was negative 2%. They're still investing, though, highlighted things like Scotia Smart Investor enhancements, virtual advice growth.
And mortgages.
Their Mortgage Plus solution, bundling products, is driving 88% of new mortgages. Renewal retention is high. And the Scene Plus card strategy seems to be getting traction. Nearly 26% of members have a payment product now.
Okay, international banking.
Reported earnings of $681 million. That's up 2% from Q1 and 4% year over year.
Who drove that?
Good expense control, mainly. And interestingly, lower impaired PCLs compared to Canada.
So cost savings are coming through.
Looks like it. Productivity ratio improved to 51%. They're on track for their $800 million medium-term savings goal. They're rolling out retail segmentation, expect tailored offers by year-end. Commercial segmentation is done. And they're improving client experience, like faster onboarding.
And the international part of GBM.
Strong results there, too. $303 million earnings, up 8%, particularly from Peru, Mexico, and Chile.
And the other segment. Usually a drag, but...
much better this quarter. Adjusted net loss of $80 million, but that's an improvement of nearly $100 million from Q1.
Why the big swing?
Lower funding costs helped NII, plus they got the full quarter contribution from that Key Corp investment we talked about. That added $68 million right there.
Okay, that covers the segments. Let's circle back hard to credit risk. This feels like the core story this quarter. Management acknowledged the uncertainty.
They did. High uncertainty globally and in Canada. And again, those PCLs. $1.44 billion, 75 basis points. The absolutely crucial point is the $236 million increase from Q1 was entirely, actually more than entirely, due to performing provisions.
More than entirely.
Yeah, performing provisions rose $346 million. Impaired PCLs for loans actually bad fell by $12 million. So they're building reserves for potential future issues based on outlook, not reacting to a current blowup.
So why the big performing build now? What changed in their outlook?
Two main things. Deteriorating forward-looking indicators, the FLIs. Think weaker GDP forecasts, higher unemployment projections in their models. And layered on top of that, their expert credit judgment, or ECJ.
And the ECJ was influenced by?
Trade uncertainty and tariffs. They explicitly called that out as a key factor driving the overlay in their base case economic scenario.
How did this break down across the bank?
Well, in retail, it was a mix of those weaker macro FLIs plus the ECJ overlay. For non-retail, so business loans, they did a deep dive and specifically identified trade-sensitive sectors, auto, agriculture, manufacturing, and applied an ECJ overlay there too.
Looking at Canadian banking again, PCLs jumped to 72 basis points, up 25 quarter over quarter. Where did that come from?
Within Canadian banking, retail PCLs were up $190 million from Q1 to $613 million. Again, mainly that performing build across mortgages, personal loans, cards. The impaired retail ratio did tick up 3 BPs to 45 BPs.
Okay, so some actual increase in bad loans.
A bit, yeah, driven by higher write-offs in unsecured loans and auto. But the big dollar increase was performing. Canadian commercial PCLs were also up $192 million, again driven by performing builds, skewed to those tariff-impacted industries.
This connects to something they discussed in the Q&A, the difference between what they're seeing in their portfolio versus some aggregate consumer stress data out there.
Right. Management's take is that customers are definitely being cautious. You know, cutting back spending, maybe switching to cheaper brands, putting off big decisions like buying a house. That slows down demand for new loans.
Which impacts growth.
Exactly. But it's not yet translating into a massive spike in people unable to pay their existing Scotia debts. They stressed the performing build is preparation for potential stress down the road, driven by that weaker outlook, not a reaction to widespread current defaults in their own book.
What about mortgages specifically? Always a focus area.
Interestingly, 90-day delinquencies in Canadian mortgages held stable at 24 basis points. And they think delinquency among variable rate borrowers is stabilizing, maybe helped by rate cuts.
But there was that jump in Stage 2 mortgages. Loans showing some increased risk, but not yet delinquent.
Yes, Stage 2 Canadian residential mortgages increased by $9 billion quarter over quarter. That sounds big.
Why such a large increase? Is it concentrated somewhere?
Management said no, it wasn't specific geography or postal codes. It was driven by their models picking up those weaker forward-looking indicators, unemployment, GDP, plus their expert judgment overlay again. A broad addition across the mortgage book based on that dimmer forward view.
Okay, shifting gears. International banking PCLs were actually down 9 basis points to 137 BPs.
Yeah, quite different. Impaired PCLs fell $52 million internationally. Performing was basically flat. Retail impairments were lower across most countries.
Except Mexico.
Mexico saw a targeted performing build, about $17 million, due to a weaker outlook there. They noted the total allowance in Mexico is up about 16% over the last 2 quarters, which, interestingly, is roughly similar to the build they've done in Canadian retail performing.
So that diversification helps smooth things out.
Absolutely. Chile, Peru, the Caribbean are feeling the same pressures as North America right now. And they think their focus on client segmentation and primacy helps build stickier, better performing relationships internationally too.
What's their forecast for impaired PCLs going forward? The actual bad loans.
They expect the all-bank impaired PCL ratio to stay around or maybe slightly above the Q2 level of 57 basis points for the rest of 2025. International impaired has actually been trending down, helped by things like selling a business in Peru and better collections. Canadian impaired is still rising, but they say the rate of increase is slowing.
So big performing build signals caution for the future, but actual impairments might be stabilizing or growing more slowly.
That seems to be their message, based on their current book and actions. Overall, the total allowance for credit losses, the ACL, is up to 95 basis points of loans. That's $7.3 billion. They've added $1.8 billion since late 2022, mostly performing. They feel well provisioned.
Got it. The other key theme, especially from the Q&A, was this strategic shift in GBM and international banking, moving away from just lending volume.
Yeah, deliberately shrinking loan balances in some areas. It's about being more selective, optimizing RWA, and shifting focus to being a broader relationship bank, driving fees, cross-selling non-lending products, rather than just being the primary lender. Value over volume.
Is this a short-term thing?
They see 2025 as transitional. They expect both international commercial and the capital markets loan books to start growing again in 2026, driven by transaction banking, investment banking momentum. They mention low utilization rates now, and that shifting away from just lending takes time.
What about the buyback? How does the uncertain outlook affect that?
They said they'll be thoughtful about the pace, but they have plenty of flexibility. They're comfortable down to maybe 12.5% CET1, and they're at 13.2%. That buffer is about $3.5 billion in capital. The 20 million share buyback is only worth about $1.5 billion, so room to maneuver.
And that key corp investment? Any lessons learned mentioned?
Yeah, beyond the $68 million contribution this quarter, they talked about observing the changing U.S. regulatory scene. They sounded optimistic that maybe things are becoming more favorable for U.S. banks, which could create positive tailwinds across North America, helping Scotia, too.
Let's touch on Canadian deposits again. They acknowledged a challenge with the mix, right? Too many high-cost GICs versus low-cost checking savings.
They did. They know they have historically had a higher GIC mix. They're tackling it end to end, changing frontline incentives to push for core deposit growth and cross-sell, more marketing, better savings products, digital acquisition, using things like Mortgage Plus to pull in day-to-day banking relationships too.
Is it working?
Retention on maturing GICs is okay. 90% stay with the bank, 60% roll back into term deposits. But accelerating that core, sticky deposit growth is, they said, a #1 priority for Canadian banking. Lots of effort going in.
And wealth management. How did it handle the market ups and downs this quarter?
They acknowledged the volatility. Flows were strong in February, dipped in March when tariff talk heated up, then recovered in April. But despite that chop, earnings grew 17%.
What drove the earnings then?
Moderation in fee-based earnings was offset by strength in private banking, higher cash balances clients were holding, and good iTrade volumes. They expect volatility continues until the U.S. tariff stuff settles, but the focus remains client advice.
Okay, let's try to synthesize this for you, the listener. It's a complex quarter, isn't it? There's this real dichotomy.
Exactly. On one hand, you have significant caution that huge performing PCL build driven by external worries like tariffs and weaker macro forecasts. On the other hand, you see clear signs their underlying strategy is working in spots.
Like where?
Capital strength is obvious, the loan-to-deposit ratio improving, real traction on client primacy metrics, new clients, advisor activity, strong results in wealth, that surprising fee strength in GBM, and the efficiency gains coming through in international.
That performing PCL build is the big question mark, though. Does it mean things are about to get really bad? Or is it just smart, conservative planning for potential trouble?
Management definitely framed it as the latter.
Yeah.
Proactive preparation based on the outlook, not a reaction to current widespread stress in their book. That divergence they mentioned between their experience and aggregate data is key here.
And that strategic shift in GBM and international, less loan volume focus, more relationship banking.
That's a long game. It might mean slower headline loan growth for a bit, but the goal is higher quality, more profitable, stickier earnings down the road from fees, and better risk management. You need to understand that context when looking at their loan trends.
So their guidance, 5-7% EPS growth for this fiscal year, pick it into the second half, then double-digit growth in 2026. What needs to happen for that?
A few things. Some macro stability, maybe some clarity on tariffs would help, and continued execution on their strategy, especially getting Canadian banking's deposit mix and productivity moving in the right direction and seeing those primacy efforts pay off more broadly. Their guidance, by the way, includes the key corp benefit, but also assumes the impact of this PCL build. It doesn't include any potential boost from the buyback yet.
So for you as an investor, this deep dive shows how Scotia is navigating the chop. You see the strengths capital, wealth, GBM fees, international efficiency, client acquisition wins. You see the challenges, Canadian banking margins and productivity, that core deposit mix, and that PCL build. It's a signal about their risk view, even if the current defaults aren't terrible.
It tells you how they're positioning themselves for what might come.
Okay, let's pivot to our This Is Not Financial Advice segment. Just thought experiments, illustrative ideas based on the call, not recommendations.
Definitely not recommendations.
Okay.
Okay. Idea 1, maybe a bit outrageous, but hear me out. Management sounded pretty convinced Canadian mortgage stress is stabilizing for them thanks to rate cuts helping variable clients and their own portfolio management. They expect impaired PCLs to be stable or only edge up slightly.
Okay, but aggregate data sometimes paints a bleaker picture for the Canadian consumer.
Exactly. So the outrageous but plausible idea. What if the market, looking only at aggregate data, is pricing in too much near-term pain across the entire mortgage sector? Maybe Scotia's experience reflects a reality that isn't quite as dire for all well-managed books.
So the tactical play.
Could be something like long, short-dated, out-of-the-money put options on a basket of maybe less diversified Canadian mortgage lenders or smaller regionals. The thesis isn't that everything's fine, but that the market might be over-discounting based on aggregate fear, offering a volatility trade if broader bank results start confirming Scotia's view of stabilization in well-managed portfolios.
Contrarian, definitely. Okay, idea 2.
Also contrarian, remember that surprisingly strong M&A revenue in GBM? First half fees beat all of last year, despite the uncertainty. And they talked about an inflection point coming, a better environment in 2026 for GBM.
Suggests pent-up demand.
Potentially, even if announced deals look slow now. So the outrageous thought, bet on M&A advisory bouncing back sharper than expected. How? Maybe go long shares of a smaller pure-play Canadian M&A advisory firm.
Why smaller?
Plausibility check. A smaller firm might have higher operating leverage to fee income swings. If Scotia's right about underlying activity and pent-up demand and macro improves, a focused advisory shop could see a huge acceleration in fees, maybe more dramatically than a diversified banks division. Highly sensitive to macro, yes, but plausible based on Scotia's specific commentary.
Got it. And just to hammer it home.
Not financial advice, just connecting dots from the call for discussion.
Right. So to quickly recap the deep dive, Scotiabank's Q2 earnings were heavily shaped by that big performing PCL build, reflecting management's caution on the macro and tariff outlook.
But beneath that, you saw solid execution in key areas like wealth, GBM fees, and international efficiency. Capital strong, liquidity strong.
Outlook is for acceleration into the second half for 5-7% EPS growth this year, then aiming for double digits in 2026, assuming the macro doesn't derail things and their strategic initiatives, especially in Canada, keep gaining traction.
And one last time, none of this constitutes financial advice.
We covered a lot from that call. As you digest this, what stood out most to you? Are you seeing these same themes, the caution versus execution tensions, the specific credit signals playing out elsewhere? Let us know your thoughts.